Okay. So we did the loan estimate and we did the CD, the closing CD. So I'm going to skip this. We still have 5 more pages to go. Okay. So your home loan resource kit, I said this before on chapter 14. It's called your home loan toolkit, which must be provided to a mortgage applicant as part of the loan application process through other real estate professionals such as brokers are encouraged to make the booklet available to prospect borrowers. So just sent a message to Bruno that you couldn't check in on the second half because he's leaving now. He's not here anymore. I can't tell him. So the booklet informs the borrower about the settlement closing process and how to find the best mortgage. It includes numerous resources of additional information as well as a detailed description of the loan disclosure CD form like you guys are seeing now. Your home loan toolkit replaced the previously required settlement cost booklet on October 3rd, 2015. Now, we're also looking at the Mortgage Disclosure Improvement Act, okay? Which went into effect on July 31st, 2009, altered the way buyers and sellers, lenders and mortgage brokers, title agents, and other real estate professionals prepare for closing. The goal of this law is to prevent consumers from receiving intentionally low interest rate during the loan application process, only to discover a settlement that the lender is charging more fees. The MDA requirements have now been incorporated into the CFPB disclosure requirements. As previously mentioned, the lender may only charge a reasonable fee for assessing the applicant's credit history until the applicant borrower receives the loan estimate. Furthermore, the lender must provide the loan applicant with the statement stating that the applicant is not obligated to complete the transaction simply because disclosures were provided or because the individual applied for a loan. In general, if the APR rises by more than 0.25% from the closing disclosure, the creditor must provide a new disclosure with the revised APR and wait 3 days before closing the loan. If the consumer has a personal emergency, such as a foreclosure, he or she may expedite the process. Everyone involved in real estate transactions should double check that loan estimate and closing disclosure forms are consistent with the original application before closing. Preparation of closing statements. A typical real estate transaction requires accounting for both parties' expenses on the closing disclosure, which is required for any federally related closing. All expenses must be itemized to determine the exact amount of cash required from the buyer and the net proceeds payable to the seller. These include prorated items such as those prepaid by the seller for which the seller must be reimbursed. So we're going to look at this prorated items, okay? Because it happens towards the end of the closing where who gets paid what, when, such as those prepaid of the seller for which the seller must be reimbursed, such as taxes and expenses incurred by the seller but billed to the buyer, such as mortgage, interest paid in arrears or unpaid when a loan is assumed. How the closing statement works. The statement procedure consists of 5 basic steps. 1, to determine the term of the sale and closing costs. 2, calculate the non-prorated debits and credits. 3, calculate the prorated debits and credits. 4, finish the closing statement. Disperse the funds. Terms of the sale and closing costs. The price of the property, the buyer's deposit and down payment, and the terms amount of the buyer's financing arrangements are the selling terms. Closing costs are final costs that the buyer or seller must pay to complete the transaction. The sale contract specifies all selling terms as well as who bears with cost. Expense allocation is subject to negotiation and in the absence of a specific agreement is determined by custom. Broker fees, mortgage-related fees, title-related expenses, and real estate taxes are all part of the closing costs. And we saw this in the breakdown that I showed you. Now, credits and debits. You might see a question on the state exam, so please pay attention. The closing statement accounts for the buyer, seller's debits and credits to settle and complete the transaction. A debit is in the amount of one party must or has already paid prior to closing. A credit is an amount that a party is obligated to receive at closing or has already received prior to closing. The amount the buyer must bring to the closing is the excess of the buyer's debit over the buyer's credit. The amount the seller will receive at closing is the excess of seller's credits over the seller's debit. Here, you might see a question on the state exam. Buyer's debts and credits. The buyer's debts are totaled and compared to the buyer's credits to determine how much money the buyer owes at closing. The buyer must bring the excess of debits over credits to the closing, usually in the form of a cashier's check or certified check. Seller's credits and debits. The same procedures followed by the seller's debits and credits to determine how much the seller will receive at closing. The seller will be paid the difference between the credits and debits. Items not prorated. Non-prorated costs are those incurred solely by one party. These are only expenses or debits. Items to be prorated. Many of items to be settled at the closing are partly the buyer's responsibility and partly the seller's. Some are expenses paid in advance by the seller, could be the taxes, and the other buyer owes the seller a portion of the expenses. Some are income items received in advance by the seller, and the seller owes the buyer a portion of that income. Others are items that the buyer will pay in arrears, and the seller owes the buyer for the portion of the cost. Proration is a method of dividing financially responsibility for such items. A prorated item always results in a debit to one party and a corresponding credit to another party for the exact same amount. Items paid in advance. The seller has paid some items in advance that cover a period that extends beyond the closing date at the time of the closing. The seller has effectively prepaid some of the buyer's expenses, and the buyer must reimburse the seller. Heating oil and natural gases are common items. Similarly, the seller of the rental property may have received advance rent or rental deposits and must reimburse the buyer for the portion that belongs to the buyer. The buyer receives a debt, and then the seller receives a credit for an expense paid in advance by the seller. Please, when you guys are studying, study this also, okay? The buyer receives a credit and the seller receives a debit for income received in the advance by the seller. Okay, any questions? Okay. We're good. Items paid in arrears or accrued. At the time of closing, the seller has incurred certain expenses that have not been billed or paid at the time of closing, and that the buyer will have to pay later. Real estate taxes are a common item. For an item the buyer will pay in arrears, the buyer receives a credit and the seller receives a debit. Expenses. An individual expense item owed by one party to a non-transactional party, such as an attorney or the state, is treated as a debit to the party only. An item of income or expense that affects both parties is proportionate or prorated to each party to reflect the proper amount owed or received. Broker's compensation. The obligation to pay a real estate broker's commission will have been established for prior agreements. If the broker represents the seller, the commission is typically paid by the seller. Okay, we can't say the commission is paid by the seller. It typically is paid by the seller. At one point, the commission can also be paid by the buyer, broker. If a representation agreement exists between a broker and a buyer, or if there are two representatives, one for the seller and one for the buyer, the commission may be split as an expense between both parties or according to another arrangement. We're also going to see attorney fees. And I said this before, when you start working with an attorney, someone asked me, do you have to pay them even if you don't close? Okay, they're not like real estate agents. They are getting paid for their service, and it's prorated among what they've done already for you. If one of the party's attorneys will be compensated for the proceeds of closing, that party will be charged for the expense in the closing statement. This cost may include costs for document preparation, review, or representation at the settlement. Now, we also have recording expenses. Typically, the seller is responsible for any recording fees, filing fees required to cure any defects, any provided the buyer with a marketable title. Items typically charged the seller include the recording of any lease deed or mortgage satisfaction associated with the actual transfer of title. Typically, such things consist of recording of the deed that transfers title to the buyer and mortgage or deed of trusted executed by the buyer for the lender's benefit. So we also have a transfer tax. In most states, counties or municipalities, real estate conveyance are subject to transfer taxes, conveyance fees, or tax stamps. Local customs and the terms of the sales contract determine who is responsible for paying these fees. And if I don't know if you saw it, it's there in the CD. Okay. All right. Title expenses. Anybody have any questions? No? Okay. Local custom determines who is responsible for title related fees. Usually the seller is expected to provide documentation of a valid title and pay for title search. If the buyer's attorney examines the evidence, or if the buyer acquires title insurance, the buyer is responsible for the cost. So here we have the local, it says the local custom determines who's responsible for title related fees. Here in New Jersey, and I know we haven't done the New Jersey portion of real estate, okay? But usually is the seller who is expected to provide that documentation of a valid title and pay for the title search. Now, we also have loan fees. When the purchaser is securing a mortgage to finance the purchase, the lender, mortgage company, or bank usually charges a service fee or origination fee. The fee is flat charge and is usually paid by the purchaser at the time of the transaction is closed. Also, the buyer may be charged an assumption fee if he or she assumes the seller's existing financing. In some cases, may pay discount points. Okay. Additional mortgage related fees. In the borrower's loan is insured by FHA, the borrower must pay the mortgage insurance premium. And we talked about this. In a lump sum, if it is not included in the loan amount. At the conclusion of a VA guaranteed loan, the buyer pays a financing fee directly to the Department of Veterans Affairs. If a conventional loan requires private mortgage insurance, PMI, the buyer pays an entire year fee in advance. So for the conventional loan, so because it's a private loan, they pay for the whole year. And in the MIP, it could be given at a lump sum of the amount at closing, or it could be charged in monthly throughout the year, okay, for a couple of years. Insurance and tax reserves. So we talk about escrow. Most mortgage lenders ask borrowers to provide funds for future property taxes, insurance, and premiums. We talked about this, right? PITI, P-I-T-I. These funds are deposited into an escrow account. We said that an escrow account is a type of account that is only used for one purpose. So in this case, we have property taxes, insurance, and premiums. At closing, the borrower opens the account by depositing at least the amount of outstanding real estate taxes from the date of the lien to the end of the current month. At closing, the seller will credit the buyer for an outstanding taxes. After then, a part of the expected taxes equivalent to 1 month's payment is added to the borrower's monthly mortgage payment. As a requirement of the mortgage loan, the buyer is responsible for having adequate property insurance. If not paid sooner by the buyer, the first year's premium is paid in full at closing. Effective on the date of the closing, the borrower's monthly loan payment will normally consist of principal and interest, unless the payment is interest only, plus 1/12 of the estimated taxes and insurance PITI that will be able due at the end of the following year. The lender holds the taxes and insurance in an escrow account until the bills are due. So what it's really saying is, to put it in simple terms, is that the escrow account will collect principal, interest, taxes, and insurance, okay? And now here, it says plus 1/12 of estimated taxes and insurance will be due at the end of the following year. So that 1/12 is paid the following year. The lender holds the taxes and insurance in escrow account until the bills are done. So, okay, this is the escrow account that is before, at the time of closing, because there's also an escrow account for the PITI. So now it says appraisal fee, depending on who orders the appraisal, either the seller or the buyer pays the appraisal charge. So from what I've seen, is typically the buyer who pays for the appraisal because they're taking out the loan. When a buyer secures a mortgage, it is usual for the lender to require an appraisal for which the buyer typically pays. If the charge is paid at the time of the loan application, it will be reported as having been paid prior to closing on the closing statement. Okay. We have survey costs. If the purchaser obtains a new mortgage financing, he or she customarily pays the survey fees. In some cases, the sales contract may require the seller to furnish a survey. Has anybody seen problems of encroachments before? Have you ever known of an encroachment? I have a friend here, associate. She has a house and she's gonna put it up for sale. And she has a driveway, but the house next door to her doesn't have a driveway, okay? So somehow she says that she found paperwork saying that 1907, she had the right of way in that driveway. So she's trying to make it an easement, because she says that my friend, who's the associate, is encroaching on her property. They've even had a survey which says the property belongs to my friend, but this woman continuously is asking for the driveway to be divided in two and then closed off so she could use that part of the driveway. But it's so small, she's not gonna fit her car through it. She wants to put a gate to the end of where the front of the beginning of the house is, so that way nobody can use the driveway. So right now, what happens is she has to go to court, okay? And she has to prove that driveway belongs to her. So I've even heard in Montclair that there was a woman who bought a house and they tore down the garage and they built a new garage, and they went 4 feet across the land of their neighbor. And in that case, that neighbor could have said to the new neighbor that was moving in with the garage to take down the garage, so that way they wouldn't encroach in their land. But somehow the neighbor ended up selling that part of the land to them, but with a condition that if a new homeowner came in, they had to take the garage down. So yeah, it was weird. It was weird, but that was the provision that they had, because they weren't supposed to be encroaching in their property. So let me tell you, encroachments right? So this says here, the survey is very important, especially before buying the house, because at that point, if there's too many problems with the house, there can be some type of contingency to get out of that contract, okay? So let me ask you, do you think contracts at closing tables fall apart? So we have someone say yes. I'm going to give you an example. There was a house in East Orange, on the nice side of East Orange, right in back of Glenridge. And I kept calling that realtor, okay, because I wanted to know what that house had been appraised for, because I had another house that I was trying to put a CMA together for the seller, but there wasn't enough properties. I don't know if you noticed but in Newark, East Orange, Montclair, there's certain areas that houses differ from other houses. They're not the same. Like if you look in Bloomfield, you'll look at the colonial, right? Detached or attached. You look at a duplex, you look like a multifamily. But when these cities who are older, they had homes custom built. So they're very different. So sometimes when you're trying to do a CMA, we haven't gotten to appraisals yet, it's very hard to put a number on that house. Sometimes for the town, we look around to see what are the comparables. If not, we can go a mile out of the town to see if there's anything similar. So with that being said, the woman said, just because if it was East Orange, they were selling the house for $700,000 with $14,000 in property taxes. Believe it or not, East Orange has very high property taxes. Okay, so they couldn't get the appraiser to appraise the house at $700,000. The appraiser came back at $565,000. So imagine that is another $200,000 that the buyer has to come up with so that they can buy the house. And she couldn't tell me the sales price. I found this out after they closed, because they can't tell you what the sales, I mean, they can tell you what the sales price is, but they can't tell you what the client offered. In the end, when they did close, I did call her and I said, you know what, can you tell me now? And she was like, well, because the buyer wanted, okay, because the buyer wanted to buy the house and he had the money in cash, he was able to pay the difference. So appraisal is very important also in the closing process of the transaction. Why? Because if your buyer can't come up with the rest of the money and the appraisal is too low, the deal falls apart. So this is what I'm telling you. Even though you come to the closing table, right? And until everything is signed and the papers are transferred to the buyer and the keys are given to the buyer, you have closed. If not, let's say inspections, right? There's too many repairs that have to be done to the house. So it takes, the value of the house goes down, okay? And this buying frenzy, people were waiving inspection, waiving appraisals. Now they're stuck with properties that have many problems. So at this point, because they're stuck with so many problems, they might have to take out a construction loan to be able to fix those houses, okay? Or a 203K loan to also fix, or fix that house and sell it maybe if they're underwater. But by saying this is, my thought here is that, even though we already close at closing, the commitment, what happens if the buyer loses their job? Now they can't do a loan commitment, right? We're even selling that even at closing, even at the day of closing, the lender is calling to see if the buyer still has a job, because they don't want the buyer to default on the loan. So there's many factors. That's why I said before in the beginning, you are stressed because you're hoping that everything runs smoothly. I also had a transaction right now with solar panels. Okay. The seller was saying that it was low utilities because of the solar panels. But guess what? The solar panels weren't bought out. They were owned by the seller, but they still had to pay Tesla for the monthly payment of the panels for the next 15 years. So that has to do a lot. Let me tell you, solar panels could be a big deal breaker for you in a deal. Okay. And so we haven't talked about this, or we have, I'm sorry, because I'm doing morning and evening, so I'm kind of mixing them up a little bit. But you have a property disclosure that you have to look at. And it's in the MLS for you to look at and see what is the problem with the house. Maybe something's not stated, like the solar panels. It said owner owns solar panels, but they're really not owned until they're paid off in full after 15 years. So Tesla bought out a lot of solar companies here in New Jersey. And so they get paid for those solar panels, Tesla. So in the end, they were looking at kilowatts, which drove me a little crazy because they already knew the price that it was per month. It was consistent, but they wanted to know the kilowatts before they even consider continuing with the home. So there's a couple contingencies inside that contract that can get you out, which it could work in your favor. As the same thing, there's other contingent, the seller has to go through, right? The only time that they can come out of the contract is if they accepted another offer, right, over attorney review, okay? They could cancel the contract with you, with the attorney, okay? I'm giving you insider information. And then on top of that, okay, they have to wait. But if they're waiting for a long time, they can also say, we're not closing here. So they could have a reason to also terminate the contract. So there's a lot of things that go into a closing until you close. Like I said before, you get the papers, you get the keys. That's when you have completely closed. But a deal can break apart in the executory period when you're having inspections, appraisals done to the house. All right, so now we have accounting for expenses. Now we're going to look at this debt. Expenses paid from the closing proceeds are debt only to the party responsible for the payment. An expense item such as escrow fee, settlement fee, or transfer tax may occasionally be split between the buyer and the seller. In such a circumstance, each party is charged their prorated share of the expenses. So now we're going to see this here more in a diagram so we can understand it better. So we have credit to the buyer, debit to the buyer, credit to the seller, debit to the seller, and prorated. It says principal amount of mortgage, credit to the buyer. Okay. Pay off existing mortgage, a debit to the seller. Unpaid principal balance, if assumed mortgage, a credit to the buyer, and a debit to the seller. Okay. So now we have accrued interest of an existing assumed mortgage. So it says a credit to the buyer and a debit to the seller. We have tenant security deposit is a credit to the buyer and a debit to the seller. Purchase money mortgage, a credit to the buyer and a debit to the seller. Unpaid water and other utility bills, it's a credit to the buyer and a debit to the seller and prorated. Selling price, oh, I'm sorry, I skipped one. Buyer's earnest money is a credit to the buyer and, okay, there's nothing there, I guess. All right, it's a credit to the buyer. Selling price of property. Wait a second. Okay, so selling price of property is a credit to the buyer, a debit to the buyer. I'm sorry, it's I'm sorry, wait, hold on a second. I'm trying to look at the line. So it's a debit to the buyer and a credit to the seller. Fuel oil on hand is a debit to the buyer and credit to the seller, and it's prorated. Prepaid insurance and tax reserves for mortgage is a debit to the buyer and a credit to the seller, and it's prorated. Refund to seller or prepaid water changes is, it has nothing. Similar utility expenses, debit to buyer, credit to seller, and it's prorated. Prepaid general real estate taxes, debit to buyer, credit to seller, and prorated. Okay, this chart is based on generally applicable practices. Closing practices may be different in your state or county. Okay, that's the disclosure there. Computing prorations. Now we're going to look at, give me a second. We're going to look at prorations here. It says the primary methods of calculating prorations. Okay, so I have somebody that left because their computer overheated. Thank you, Katie. I'm sorry I didn't read that before. Lines over someone else's property. Okay, that's an encroachment. Computing prorations. The primary method of calculating prorations are the 360-day method, which computes prorations on the basis of 360-day year and 30-day month, and 365-day method, which computes prorations on the basis of 365-day year. The 360-day method is commonly used for prorating mortgage interest. We don't do this, but we learn how it is used. Either method may be used for real estate taxes depending on local practice. It is customary in most states that the seller owns the property up to and including the day of closing, unless stated otherwise in the contract. Thus, the closing day is apportionated to the seller in computing prorations. The method of prorating, if not specified in contract, will follow local custom. So now we have this 12-month, 30-day method. The 12-month, 30-day method determines an average daily rate of payment for an item to be prorated based on the 30-day month and 160-day year. So they're going to show us an example, and this is going to make sense for you. The method consists of following steps for the annual and monthly items. So it says here, annual items, identify the total amount to be prorated. 2, divide this amount by 12 to obtain an average monthly rate. Divide the monthly rate by 30 to obtain an average daily rate. Multiply the monthly amount times the seller's number of months of ownership in the year of the sale of the month of closing. For the month of closing, multiply by the seller's number of days of ownership times the daily amount and add the result to the previous result. The final result is the seller's prorated share of this item. So we'll look at the example here. The buyer's prorated share of an item is the total amount less the seller's prorated share. Okay, so in this example, it says the sales transaction on a single family house closes on March 2nd. County taxes for the previous year to be paid in arrears amounts to $1,730. The seller owns the house through the day of closing. What are the seller's and buyer's prorated shares of the item? Total amount due, $1,730. Monthly amount. So now we're dividing this in 12 for the months. It will be $144.17. Daily amount. So now we have to divide by days because we have the monthly amount. So the daily amount is divided by 30. It's $4.81 a day. So seller's share, $144.17 times 2 months is $288.34. That's what the seller's share is. Now we continue at $4.81 times 2 days, $288.34 plus $9.62 equals to $297.96. So the buyer's share is 1,730 minus 297.96, and you'll see here the reflection is 1,432, because we're talking about the days that the buyer has to pay. Closing statement entries. The seller will be charged for the seller's share of the proration in an amount of 297 days. I'm sorry, 297 and 96 cents will be entered as a debit to the seller and a credit to the buyer because the buyer will have to pay the seller's share when the tax bill is received. And so you divide it in by months, days, and then you get the share for the seller and the share for the buyer. So here we have monthly items. Identify the total amount to be prorated. Divide this amount by 30 to obtain the average daily amount. Multiply the daily amount times the seller's number of days of ownership. The result is the seller's prorated share of this item. The buyer's prorated share of an item is the total amount less the seller's prorated share. So we have here, it says the house in the previous example has been rented during the listing and selling period at a rate of $1,800 per month. Rent for the month of March was paid to the seller on March 1st. What is the buyer's prorated shares of this rent? The day of closing, March 2nd, belongs to the seller. So now we have here, it says a total of 1,800. Daily amount, 1,800 divided by 30 is 60. That's a daily amount. Times 2 days is 60 times 2, it's 120. And then the buyer share is 1,800 minus 120 is 1,680. Closing statement entries. The seller will be charged for the buyer's share for the proration. An amount of 1,680 will be debited to the seller's account and credited to the buyer's account because the seller has received rent that belongs to the new owner after closing. Again, you won't have to worry about this in the exam. It's for you as an overview to know. Okay. Now, we're looking at the 365-day method. Okay. Uses the actual number of days in the calendar. The steps in the calculation are the same for the annual and monthly prorations. The steps are. Okay, give me a second. So we have here, says the 365-day method usually is the actual number of days in a calendar. This step in the calculations are the same for annual and monthly prorations. The steps are to identify the total annual or monthly amount to be prorated. For an annual proration, divide the total amount 365 to obtain a daily amount of 366 in a leap year. For a monthly proration, divide the total amount by the actual number of days in the month to obtain the daily amount. Multiply the daily amount times the seller's number of days of ownership. The result is the seller's prorated share of an item. A buyer's prorated share of an item is the total amount less the seller's prorated share. Okay, so now we're going to take a look at this. Okay, so it says the seller is, the previous example has a 1,730 tax bill paid annually in arrears on December 31st. Closing on March 2nd, and the seller owns the day of closing. What is the seller's prorated share of an item? So we have the total amount, okay? We have the daily amount, and we have the seller's shares. So the total amount is 1,730. Now we're going to divide that number by 365, okay? Because that is the daily amount that we need. So it's $4.74. Now the seller's share for 61 days times the daily share gives us $289.14. So it says that now the buyer's share says 1,730 minus 289.14 equals 1,440.86. Closing statement entries. The seller will be charged for the seller's share of the proration. an amount of $289.14 will be debited to the seller's account and credited to the buyer's account because the buyer will have paid the seller's share of the tax bills in arrears. Now, we have a sample here of a statement worksheet. Okay, so now it says settlement date and buyer statement and seller's statement. Purchase price, $425,000. Okay, it's a debit to the buyer and a credit to the seller. So this is a little bit so you can understand some of the disclosures that we see. Earnest money deposit. It will be a credit back at the end of the closing to the buyer. Okay, the buyer can't also use their earnest money deposit as part of the loan, but they usually get it back at closing. Additional deposit. So that is an additional deposit. Usually in the sales contract, you see initial deposit, and then you see an additional deposit. Okay, so this additional deposit is $41,500. Okay, survey. The survey was a debit to the buyer for $120. First mortgage proceeds. Okay, that is a credit to the buyer. So they're getting the loan amount for the purchase price, right? So they're getting $340,000. Then we have title insurance, $1,700. That is a debit to the buyer. Now, interest prepaid to 6/1/22 is $992. It's a debit to the buyer. Recording documents, a debit to the buyer, $70. Paying off existing mortgage. For the seller, it's a debit of $44,000. That's what they net. So, I'm sorry, that's what they had to pay. And interest on existing mortgage balance, $229. It's a debit to the seller. Commission paid to broker, $25,500. That is a debit to the seller. Taxes prorated, it was a debit to the seller and a credit to, a debit to the buyer and a credit to the seller. Title search, $160, a debit to the buyer. Realty transfer fee, it's a debit to the seller. Loan discount, it's a debit to the seller, 6.800 to the buyer. Attorney fee, $1,200, a debit to the buyer. Subtotal buyer, $437,767. It's a debit to the buyer. And they were credited $382.500. Balance due from buyer. So it was a credit to the buyer, $55,267. A subtotal seller has $73,184 and $426 was credited to the seller. Okay. Balance due seller. I don't know if it's supposed to be a comma or a point there. I'm not too sure. $353.541. It's a debit to the seller. And totals of $437,767 was debited to the buyer. Then it was credited and then debited $725,000. It was a debit to the seller and a credit of $426,725, right? So this is the totals on that. Okay, we have come to the end. And I know there was a lot of information. So what I'm gonna, this is like, I know it's Friday, right? It's hard. So does anybody have questions so we can go back? I suggest definitely reading this chapter over. I stress some of the stuff. Hallelujah. Masha. You should have been in person, Masha. Okay. So, go back, reread all this, but I did stress the stuff that we might see on the state exam. I don't have the keynote. Bruno will put it up. He told me I do have the quiz answers for chapter 14, and we'll go over that. Not 14. Is it 14? No, because this is 15. Yes, 14. We'll go over that. Bruno will go over that with you guys on Monday. So things that are important, right? So this is all for the closing. It tells you, it specified everything that you saw in the closing CD. These are all the expenses that are put into that, the broker's commission, the arrears, the proration, the expenses, broker's compensation. Did we do 14 already? We did 14? I'm sorry, guys. It's Friday, okay? So, all right, I guess we'll get 15. I'm sorry, we'll get 15 on Monday because Bruno didn't give it to me yet. No, the 3-day, Alexis is asking me about the cooling period. So that cooling period is when we're under attorney review. So that means it gives you time to get out of the contract, okay? So if the attorneys are looking at the terms of the contract, what happens is you have 3 days to get out of the contract, to rescind the contract, right? The attorney review process is much longer, but you have those 3 days to say, I don't want this house anymore, okay? Or the seller can get a better offer than the offer that's on the table. And that's what happened to the client that I have now that we're closing a little bit later in October, not the one that's coming up. I called the realtor and I said, you know what? I want to know, do you have any offers on the table on this house? She's like, we're already on the contract, right? I'm sorry, we're in attorney review, kind of like under contract. But she said to me, you know what? Send me the contract of sale, the offer, and we'll look at it, because the contract of sale is the same thing as the offer. Once it's accepted, it goes into a contract. And she said, send it to me so I can show it to my clients. So I go ahead and send it that day because the next day it was too late. They were under contract. So I send it to her and the owner, the seller accepts my client's contract. Okay. And so they got out of the other contract, but they were within that cooling period. You see, it could be from the buyer or it could be from the seller. The buyer can say, I no longer want to buy. And the seller could get a better offer and say, I don't want to sell to that other buyer. So that period is, it's important. Okay, it is important. And the attorney who's not going through with the process, whether it be the buyer or the seller, they have to send out a letter to the other attorney. They are no longer going through with the transaction. Okay, so with that, all right, so then we see this, all of these things that are in the closing disclosure, okay? So it's really all there. Let me go back to the beginning if there's anything that I have to address. Does anybody have any questions about the closing disclosure? I think there was one thing. Elizabeth, you have something? I think I might have skipped. Let's see. There's a. Well, no, Alexis, there's no ghost in here. We just heard a weird sound. It's only me and Alexis here. We haven't heard anything. It must, could it be the cooler? I mean, the coffee maker? Was it lid open? Was it the lid open? Yeah. Okay. So can you close it? Maybe that's why I did that weird sound. All right. We might be Alexis and me and maybe a ghost. Who knows? All right. So what I wanted to say was, okay, Katie Lee says, when exactly does attorney review happen again? Okay, so let me go up to my timeline. So I'm gonna minimize this a little bit so I can find it. Okay, so here we are. So when we're pre-offering stage means that we're putting in the offer with the seller's agent, okay? The listing agent. Now, if they accept our offer, that offer document, right, becomes, in some states, a sales contract. Okay. And then, so after they're accepted, so we are under attorney review. Okay. And this attorney review could extend further, but we have 3 days. That's what I was telling Alexis. We have 3 days to cancel the attorney review and say, well, you know what? If the buyer says, I don't want to buy this house anymore, they can back out of it. Last year, I had a property in Woodbridge. Okay. We put the house on the market in August, and we didn't see any traction on the house. Nobody wanted to see it because you know what? Kids were going back to school. You know, people were occupied going back to work or organizing themselves for work and school for their kids. So we had a dead zone of a month that there was really no interaction from any buyers. So what happens, right? Jefferson, I'm going to make it a little bigger for you so you can see it. So what happens? Then in September, it was slow. So I was like anything, all agents, we start freaking out. We're like, oh my gosh, what's happening? Nobody's interested. It's a beautiful home. It was such a beautiful home. So Masha says it's a ghost of Masha. That is true. She does get up there and go there and look at the coffee, right? No, I'm just kidding. She said that though. She said it. Okay, I'm sorry for the interruption. So anyway, so from both sides, they can cancel the contract. So you can have a seller, and this is what I just said. I'm sorry, I'm talking about the house. That's right. The house in Woodbridge. So nobody came to see it. So I started doing open houses on Saturdays and Sundays and during the week, Wednesday, Thursday, and Friday, Saturday and Sunday, to get some traction, whatever. There's people that came late to see the house and everything, nothing. Then 2 weeks later, I get a couple from New York that wanted to come and see the house. So the husband has the wonderful idea to come without his wife. That is the worst thing that you can do. You cannot go see a house without your wife. But anyways, so he came to see the house. He took a video of the house. He says that it was a beautiful house. She was all excited. They wrote up the offer and my seller accepted the contract. Okay. Accepted the offer. So we were in an attorney review. We wanted to get into contract. A day before we get into contract, the wife didn't want the house because she went to see it and she didn't like it. Okay. So that's how she was able to get out of the contract. Now the buyer, the seller wanted to be into contract, but the buyer didn't want anymore. So I was telling Alexis that I have a buyer now that we've been looking at a lot of houses, putting in a lot of offers. It was very tiresome. And they really like this house. Okay. So I called the realtor before I put in the offer because it's so much work to do an offer and not to get accepted. So I said, maybe it might not be accepted. Let me call the realtor. I called the realtor and she says, yes, we're in attorney review right now. But if you want to send your offer, my client might consider it. So I went ahead, I put the offer in, I called my buyers and I said, you know what? They might consider the offer. And she's like, yes, please send it. So that very night, the sellers agreed to my offer and took out the other offer that was on the table because they had that 3-day period of attorney review. But what did Nadia put? But the wife liked the husband's TikTok video on the house. So there was something similar to TikTok on that? That's what you're trying to tell me? Nadia? I mean, I could unmute you for a second. Like I have the power to do that. She liked the video enough, I know, but it was dark too. It was like after 6 o'clock. So you know, everything looks nice in the dark. You see a car in the dark, you think it's nice. You see your future husband at nighttime, you don't get to see all the defects. Look at him in the daytime and then you'll see. Okay. Anyways, but what I was trying to say is that for my buyer now, they were accepted the contract. So the seller accepted the offer that was better than the other offer, and they were attorney review. So they, as soon as they did the attorney review, everybody was like, oh, we need to get on the contract. So finally we were under contract. And with this deal, I'll be closing in, I think it's mid-October. And the deal that I have now is closing on the 3rd of October. So it's a little nerve-wracking. That's why in the morning I was teaching, I had like 3 different inspectors calling me. Then the attorney was calling me. I had to take a moment to answer their questions because I couldn't leave them hanging because they were doing the inspections that day. So now if you understand this, the closing phase, right? So we talked about the attorney review. Once the 3 days are over, I mean, attorney review extends, but now we're in the executory phase, right? We want to close, so we have inspections, we have repairs, credits, appraisals, lender giving the loan estimate, the CD, and committing to the loan. Once we're at the closing table, everything is signed, all the paperwork are given to the buyer, we have executed the transaction. Okay, does that make sense? For Katie, did that make sense? Okay, all right. Let me see anything else. Now we talked about IRS reporting. That information, that transaction will go to the IRS, okay? And it will be reported. For me, my broker sends me a 1099 at the end of the year with the commissions that I made. Alexander, if you're laughing without me, I cannot take this. I guess he muted himself or muted me too because he can't hear me. Alex, who are you talking to? A ghost? Who are you talking to? Oh, okay. Nice to meet you. I know it's late. All right. So let me continue here. It says lender's closing requirements. We went over that. So this is all about the closing, right? The role of the real estate agent at closing. So we have to always help our clients, even if we already handed them to the attorney. They depend on us. They want that hand holding. So now, let's say you become a top agent, okay? And maybe you have already 10 deals on the table. You might have to have an assistant to help you, a licensed assistant to help you with talking to clients. And I've heard this complaint from other clients of friends that I have, that the realtor wasn't really as involved. But honestly, you don't have to be as involved when you're already at the closing table, because the attorney is the one that should be doing their work to help the clients. But again, if you want everything to go smoothly, you'll be part of that transaction. Okay, so we talked about evidence of title, survey, final property inspections, the walkthrough, okay, buyer's concerns, closing procedures. Okay, so after all this, I would like to know if anybody else has a question. Let me see, what's this? I know she liked the video so much and she accepted the offer. But you know what it is? Sometimes people have been looking for such a long time. And at that period, we had the buying frenzy. So at one point, people were like, yes, go ahead, submit the offer. I'd rather have a house than not have anything at all. You know what I mean? So then they got to really look at the house and maybe they liked the house. And then they had another offer for another house that was accepted. Okay,